Hello, everyone. This is JT Rick, EVP of Finance and Investor Relations. Welcome to the pre-recorded discussion of Flowers Foods 2024 fourth quarter and full year results. We will host a live Q&A session this morning at 8:30 a.m. Eastern. Further details about the live call, along with our earnings release, a transcript of these recorded remarks, and a related slide presentation are posted on the investors section of flowersfoods.com. Before we get started, keep in mind that the information presented here may include forward-looking statements about the company's performance. Although we believe these statements to be reasonable, they are subject to risks and uncertainties that could cause actual results to differ materially. In addition to what you hear in these remarks, important factors relating to Flowers Foods business are fully detailed in our SEC filings. Providing remarks today are Ryals McMullen, Chairman and CEO, and Steve Kinsey, our CFO. Ryals, I'll turn it over to you.
Thanks, JT. It's a pleasure to welcome everyone to the call. Although I'm proud of our team's execution in the fourth quarter and full year of 2024, financial results were mixed. Category weakness drove the lower than expected sales, but that pressure was more than offset by margin expansion, which benefited from efficiency initiatives and moderating input costs. I think it's important to point out for context that we grew dollars and units in tracked channels across our branded bread portfolio in 2024. We've documented for several quarters now a consumer shift away from traditional loaf toward more differentiated and premium items. I'm pleased to report that due to our brand investments, gains in organics, keto, buns and rolls, and gluten-free more than offset softness in those more traditional segments. Furthermore, while our food service volumes were down, mostly due to intentional exits and to some extent from weakness in the category, we nevertheless showed respectable dollar growth. And due to our portfolio strategy, our food service business turned in substantially improved profits. The biggest headwind we face from both a revenue and a volume growth standpoint is significant weakness in the sweet baked goods category. However, we're addressing that headwind straight on with the introduction of Wonder Snack Cakes, for which we've received tremendous retailer enthusiasm given the iconic Wonder brand and our superior quality. Overall, we believe our portfolio is well positioned to capitalize on the seeming secular shifts in the category to more premium and better for you items. So turning to weakness in the bread category, the causes are difficult to isolate, but some attribute it to a variety of factors, including an economic slowdown, GLP-1s, and healthier eating trends. As I mentioned, much of the pressure has been focused in sweet baked goods and traditional loaf products like white and wheat bread. To overcome retail headwinds, we're investing in our brands to meet the needs of an evolving consumer, finding pockets of growth in a slowing bread category. While the category has softened, buns and rolls, breakfast, and premium products have outperformed, and we're targeting our innovation at those more promising areas. That investment is paying off as each of our major bread brands gained or held unit share and dollar share in the fourth quarter. The away-from-home category has been similarly challenged, but our prioritization of profitability over volume has improved results. We're refilling freed-up capacity with higher margin business, and we see significant opportunity to drive future growth. While we work to improve near-term results, we're dedicated to enhancing long-term shareholder value. This evaluation includes our brand portfolio, the way we go to market, our distribution model, and supply chain. I'll provide greater detail on some of these initiatives and how we're taking specific actions to drive improved performance. Ultimately, our goal is to transform Flowers into a faster-growing, higher-margin business that will compound shareholder value over time. Part of that process will be enabled through M&A, such as our announced acquisition of Simple Mills. But we must also optimize our existing business, such as with the introduction of Wonder Cake products, which I mentioned earlier. Now I'll provide an overview of our fourth quarter and full year performance in the context of our four strategic priorities: developing our team, focusing on our brands, prioritizing margins, and pursuing smart M&A. Following that, Steve will review the financial results and guidance, and then I'll close with a discussion of key themes moving forward. Our team, which is our first strategic priority, has been faced with a series of weather events that have impacted them personally and professionally. Last quarter, we discussed the hurricanes that affected much of the Southeast and where ongoing recovery efforts continue today. More recently, fires in California resulted in widespread devastation that touched the lives of many. Thankfully, all of our team is safe and our warehouse locations have been spared. To help those who are not as fortunate, our team is working with disaster relief organizations to support community members in need. We're also working closely with customers to help provide consumers the products necessary to feed their families. We have discussed the transition of our business model in California from a partnership with independent distributors to an internal sales team. That process has continued, and despite the fires, we expect to complete the transition on schedule. The California transition is one step we're taking to drive improved long-term results. Another initiative is a targeted investment in our customer team. To drive even closer relationships with our customers and align our strategic growth plans to maximize sales, last year, we refined our organizational structure and added top-tier external talent. That investment is facilitating strong acceptance of our product innovation, improved and expanded shelf placement, and increased product displays. Over time, we expect these benefits to accelerate the market advantages of our leading brands. And that focus on our brands is our second strategic priority. In contrast to the weaker category results, where a pressured consumer drove volumes down 1.8% in the quarter, our leading brands continued to outperform. DKB, Wonder, and Canyon grew track channel volumes 2.9%, 0.5%, and a staggering 17.8% respectively in the fourth quarter. And Nature's Own, which is concentrated in traditional loaf, the area of the market most impacted by the current environment, outpaced the category, down only 1.6%. Nature's Own's more premium Perfectly Crafted line of products increased units 8.5%. That performance translated to strong unit share performance, with DKB, Wonder, and Canyon all gaining 10 basis points and Nature's Own maintaining share. Particularly noteworthy was DKB's ability to achieve positive unit growth rates in all income cohorts, which confirms the increasing preference for differentiated better-for-you products. For the year, unit sales among lower-income consumers grew the most, though that trend seemed to reverse in the fourth quarter. DKB's strength demonstrates that even pressured consumers are willing to pay for premium products that offer meaningful perceived value. And that strong consumer perception enabled DKB to achieve record levels of household penetration in 2024, eclipsing even the pandemic-influenced 2020 results. Canyon is also generating exceptional results. Freed from prior capacity limitations, the brand is successfully gaining new distribution and driving growth, helped by fresh marketing and promotion initiatives. To continue this momentum and capitalize on Canyon's strong consumer loyalty, we're also exploring the addition of new, innovative products to the brand lineup. In the current weak environment, we remain focused on maximizing our current and future growth prospects. Our continued investment in innovation has been a key driver of our strong relative performance. A great example of that is our Nature's Own Keto line of products, which gained 410 basis points of unit share to take the number one spot in the subcategory. We expect to build on that momentum with a robust schedule of on-trend innovation that targets evolving consumer demand. As consumers shift to healthier eating options, we're bolstering our Nature's Own Keto lineup with the addition of hot dog buns and a multigrain loaf. DKB snack bars and protein bars continue to gain distribution, and consumers are singing their praises, with Good Housekeeping awarding us the best protein bars of 2024, while Delicious Living named them their favorite nutrition bar product. In keeping with the healthier eating trend, we're launching our most unique product yet, DKB Snack Bites. These poppable and perfect for snacking bites are packed with killer taste and whole grain nutrition. Retailers are responding enthusiastically, and we're optimistic that consumers will love them as well. We're also meeting consumer needs regarding affordability. In this challenging economic environment, consumers have been asking for lower-priced options, and our new small loaves fit that bill perfectly. Coming in at only 12 ounces, small loaves carry a more affordable price point and are perfect for the smaller household or those who want multiple bread flavors or varieties without worrying about throwing any slices away. Our third strategic priority is margins, an area where we continue to make significant progress. Adjusted EBITDA margins expanded 70 basis points compared to the year-ago quarter, benefiting from the successful execution of our portfolio strategy and savings initiatives. To further boost margins, we're focused on optimizing our supply chain to provide the highest level of service to our customers in the most cost-efficient manner. Initiatives range from reducing production scrap, improving manufacturing efficiencies, optimizing our transportation network, and right-sizing our transportation equipment base. Similarly, our procurement team has undertaken several strategic sourcing initiatives to reduce costs. One effort includes reallocating purchases of key commodities to new suppliers at lower cost. Another uses our ERP system to route each spare part order to the supplier with the lowest total cost of ownership. And a third program has significantly reduced lease labor expenses by negotiating lower fees from existing suppliers in addition to adding new lower cost suppliers. These examples are just a small portion of our company-wide initiatives to increase efficiencies. Our fourth priority is smart M&A. In January, we announced that we had entered into a definitive agreement to acquire Simple Mills. This acquisition increases our exposure to better-for-you and attractive snacking segments, diversifies our category exposure, and enhances our growth and margin prospects. This transaction is consistent with our clearly defined M&A strategy of seeking compelling brands that complement our existing portfolio and that skew towards better-for-you products. It also leverages our demonstrated ability to grow acquired brands in the better-for-you space. Simple Mills has a loyal customer following, and we see significant opportunity to continue the brand's strong track record of growth by further expanding distribution, developing new innovative products, and increasing velocities. Slide 11 highlights some of these opportunities. With household penetration well below competitors, Simple Mills has ample growth opportunities by narrowing the gap with legacy players in total distribution points and average items per store. Those opportunities are abundant, even in Simple Mills' most mature categories. Following the deal closing, our capital allocation priority will be debt paydown, something we've done successfully with past acquisitions like DKB and Canyon. We view our M&A capabilities a key driver of future growth by shifting more of our business towards a growthier, better-for-you nutritional profile. Quickly returning to a more normalized leverage ratio will enable us to explore further opportunities. As always, we'll remain disciplined in our approach and focused on growing shareholder value with an attractive risk-reward balance. Now I'll turn it over to Steve to review the details of the quarter, and then I'll close with our outlook for the current business environment. Steve?
Thank you, Riles, and hello, everyone. I am pleased to present our fourth quarter and full year 2024 results. Net sales decreased 1.6% from the prior year period. Price mix improved 0.9%, helped by optimization of our non-retail business, most notably food service, but was more than offset by volume declines of 2.5%, largely in cake and branded traditional loaf bread. Gross margin as a percentage of sales, excluding depreciation and amortization, increased 90 basis points to 48.8% over the same quarter last year. Comparisons benefited mostly from moderating ingredient cost and optimization of our non-retail business. Lower production volumes and higher workforce-related costs partially offset the overall improvement. Selling, distribution, and administrative expenses as a percentage of sales were 40%, a 30 basis point increase over the prior year period. The increase was due to higher workforce-related costs, rent expense, and bad debt expense. These items were partially offset by lower distributor distribution fees and marketing and insurance expenses. Excluding matters affecting comparability, adjusted SD&A expenses were 39.6% of sales, up 20 basis points compared to the prior period. GAAP diluted EPS for the quarter was 20 cents per share, a 3-cent increase over the prior year period. Excluding the items affecting comparability detailed in the release, adjusted diluted EPS in the quarter increased 2 cents over the prior year period to 22 cents. Turning now to our balance sheet, liquidity, and cash flow. For fiscal 2024, cash flow from operating activities increased $63 million to $413 million. Capital expenditures increased $3 million to $132 million and included $6 million for the ongoing ERP upgrade. Dividends paid increased $8 million to $203 million. We believe our financial position remains strong. At quarter end, net debt to trailing 12 months adjusted EBITDA stood at approximately 1.9 times. We held $5 million in cash and cash equivalents and had $564 million of remaining availability under our credit facilities. To enable us to close on the Simple Mills transaction, we entered a binding commitment letter for a 364-day, $795 million term loan. We intend to replace this facility with permanent debt financing in the first quarter. Now turning to our outlook for 2025, which incorporates an expectation for near-term headwinds from the difficult current economic environment and the potential impact of new tariffs, combined with actions we are taking to drive long-term performance improvement. Including the benefit of a partial year contribution of Simple Mills, we expect sales of $5,403 million to $5,487 million, adjusted EBITDA of $560 to $591 million, and adjusted EPS in the range of $1.11 to $1.24. Excluding Simple Mills, we expect sales of $5,180 million to $5,257 million, adjusted EBITDA of $526 to $554 million, and adjusted EPS in the range of $1.18 to $1.28. Relative to the prior year, results are expected to be stronger earlier in the year, helped by the carryover of new business wins and savings and pricing initiatives, as well as moderating commodity costs. Our outlook for the back half incorporates the lapping of those benefits, increased commodity cost headwinds, and continued challenging category trends. The largest swing factor in our guidance is overall category performance. The significant category volatility in recent weeks, which drove lower than expected sales, makes forecasting full-year results challenging. We are assuming a range of scenarios that anticipate continued category weakness in bread and cake. Other key factors that could shift results within our guidance range include the promotional environment, potential new business wins, the transition of our California distribution, and implementation of our ERP initiative. Currently, approximately 70% of our key raw materials are covered in 2025. Based on that coverage, our guidance incorporates inflationary pressures compared to the prior year, with the benefit in the first quarter transitioning to a headwind for the remainder of 2025. To minimize volatility and provide adequate visibility into cost, we have maintained our historical hedging strategy, in which we attempt to increase the certainty of our key ingredient cost 6 to 12 months out. As previously disclosed, in fiscal year 2023, we reached an agreement to settle distributor-related class action litigation in California. As Riles mentioned, we are making progress with the process of repurchasing the distribution rights, which is expected to be completed in April in accordance with the settlement agreement. In the first quarter, we are resuming the bakery rollout of our ERP system, which we had paused to concentrate resources on our California distribution transition. To minimize the risk of operational disruptions, we are proceeding judiciously and are confident in our ability to execute the transition smoothly. Thank you, and now I'll turn it back to Riles.
Thank you, Steve. Now I'd like to discuss some of the trends impacting our current performance and the steps we're taking to maximize present and future opportunities. I'll first touch on the consumer trends and then address the competitive environment. Our 2025 financial outlook incorporates continued caution on the consumer and promotional environment, both of which are relatively consistent with the recent past. Consumers remain under financial pressure as inflation continues to rise, albeit at moderating rates. In response, consumers have economized in various ways, including what they buy and where they buy it. When those steps have not been sufficient to offset the higher costs, they've used credit cards to make up the difference. Increasing delinquency rates on credit card debt indicate a weakening in consumer health. Demand for private label products has persisted, though unit share gains turned negative over the last few quarters as private label price increases have outstripped those of branded products. The shift to eating at home has continued, driven partly by price increases in away-from-home channels, which exacerbated the price gap with at-home eating. And more of those at-home purchases have shifted to value channels like mass and club stores. While many low-income consumers transitioned to greater at-home eating several years ago, more recently we've seen similar behavior among higher-income consumers. Despite that shift to at-home eating, the center store bread category, as measured in track channels, has been pressured. Consumers have been gravitating more to the store perimeter as they look for restaurant-like experiences and what they consider healthier options. The impact of GLP-1s on this shift is unclear. Research seems to show that consumers who have adopted GLP-1s purchase less food and shift more of their purchases to nutrient-dense items located in the store perimeter. However, that effect seems to wane over time, and for consumers taking GLP-1s specifically for weight loss, research shows the initial impact on purchases reverses and ultimately results in consumers spending even more on center store items than prior to adoption. In conjunction with the rise of GLP-1s is greater interest in healthy eating, best exemplified by the Make America Healthy Again movement. With its focus on cleaner food labels, we feel well positioned for that shift. Going back to its introduction in 1977, Nature's Own stood out for its clean label with no artificial preservatives, colors, or flavors. Nature's Own has maintained that advantage, and more recently we've added brands like DKB and Canyon, which offer organic and gluten-free benefits to meet changing consumer demand. Our announcement to acquire Simple Mills takes this shift one step further, adding a leader in the better-for-you space with clean labels and a focus on regenerative agriculture. We are well positioned to capitalize on the trend towards healthier eating and expect a significant portion of our future growth to derive from better-for-you products. Turning now to the competitive environment, where trends have remained consistent with recent quarters. The lack of category volume growth has raised fears of increased promotional levels. And while track channel data show a step up in promotions, the average category price actually increased slightly in the fourth quarter. As we discussed last quarter, part of the explanation for that trend is a mix shift to premium products, but some is also likely due to a greater percentage of products sold on promotion, though with less promotional intensity. It's not clear that increased promotional intensity is the solution to volume pressure in the bread category. In areas of the category where promotional levels increase more meaningfully, volume lift does not seem to have benefited commensurate with the level of investment. Guided by our improved trade promotion capabilities, we've remained prudent in our use of promotional spending, carefully monitoring the return on investment. We've been pleased with the effectiveness of our promotional activity, which remains well below pre-pandemic levels. While always striving to maintain the affordability of our brands, we are also focused on providing greater value to consumers by developing unique, quality products from brands they know and trust. In recent years, our innovation team has successfully launched a number of new products, including the Nature's Own Keto line of products, brioche rolls, small loaves, and our DKB snacking portfolio, among others. And we have an exciting pipeline of additional products that we expect will continue to meet consumers' evolving demands. In closing, while I'm pleased with our team's commitment and execution, none of us at Flowers are satisfied with our financial performance. We acknowledge that our guidance is cautious given the volatile environment that we see continuing into at least the first half of 2025. The potential for tariffs, commodities volatility, higher promotional activity, and a continued weak consumer demand influence that cautious outlook. However, at the same time, we have an overall optimistic longer-term outlook given the strength of our brands and their performance in the market, our history of successful innovation, and the addition of Simple Mills to the Flowers portfolio. So, in order to mitigate these negative effects and drive growth and profitability, we have been and will continue to do the following things. Number one, aggressively innovate unique, premium products to offset the effects of a declining category. This is a proven strategy evidenced by our market share performance. Two, leverage the power of our top brands to move into other faster growing segments, like we have with our DKB snack line. Three, use M&A to focus on new growing product segments to enhance our growth and margin profile, with Simple Mills being the latest example. Four, stabilize the cake business by leveraging the power of the Wonder brand. And five, optimize our supply chain and path to market to deliver industry-leading operations and service. In short, we believe that we are very well positioned to take advantage of our opportunities, particularly as the consumer demand environment ultimately stabilizes. We're confident these initiatives will enable us to enhance shareholder value and grow in line with our long-term financial targets. Thank you very much for your time. That concludes our prepared remarks.
Good morning, and thank you for standing by. Welcome to the Flower Foods fourth quarter and full year 2024 results conference call. Please be advised that today's event is being recorded. I would now like to hand the conference over to your opening speaker today, J.T. Rieck, Executive Vice President of Finance and Investor Relations. Please go ahead.
Thank you, and good morning. I hope everyone had the opportunity to review our earnings release, listen to our prepared remarks, and view the slide presentation that were all posted earlier on our Investor Relations website. After today's Q&A session, we will also post an audio replay of this call. Please note that in this Q&A session, we may make forward-looking statements about the company's performance. Although we believe these statements to be reasonable, They are subject to risks and uncertainties that could cause actual results to differ materially. In addition to what you hear in these remarks, important factors relating to Flowers Foods business are fully detailed in our SEC filings. We also provide non-GAAP financial measures for which disclosure and reconciliations are provided in the earnings release and at the end of the slide presentation on our website. Joining me today are Ryals McMullian, Chairman and CEO, and Steve Kinsey, our CFO. Ryals, I'll turn it over to you.
Okay, thanks, JT. Good morning, everybody. Welcome to our fourth quarter and full year call. Our team accomplished a lot in 2024. We grew dollars and units in track channels across our branded bread portfolio, helped by innovation and strong market execution. And continued implementation of our portfolio strategy drove improved sales and margins in our away-from-home business, despite the impact of those deliberate business exits. Offsetting that performance has been persistent category weakness, which led to lower than expected sales results. The biggest headwind from both a revenue and a volume growth standpoint is significant weakness in the sweet baked goods category. However, we're implementing concrete initiatives to offset that weakness and believe our portfolio is very well positioned to capitalize on current and long-term trends. Looking forward into 2025, our financial guidance is cautious given the volatile environment. The potential for tariffs, commodities volatility, higher promotional activity, and continued weak consumer demand influence that cautious outlook. However, we are very optimistic that the strength of our brands, our successful history of innovation, and the innovation of Simple Mills to our brand portfolio will enable a strong longer-term performance. And with that opening, Gigi, we'll open it up for questions.
Thank you. As a reminder to ask a question, please press star 11 on your telephone and wait for your name to be announced. To withdraw your question, please press star 11 again. Please stand by while we compile the Q&A roster. Our first question comes from the line of Steve Powers from Deutsche Bank.
Good morning.
Morning, Steve.
You hear me okay?
Yeah, loud and clear.
Okay, great. Okay, sorry. Hey, so can I first ask about Dave's? It's been good, obviously, for a long time, but we've seen the core bread in that franchise start to run negative in consumption data for, I guess, about the last 12 weeks. I think it was down about almost 3% in the last 4 weeks. I'm quoting Nielsen data. So can you talk about just kind of what you're seeing there and how you expect the DKB franchise to perform in 2025, both kind of core bread and then the entire lineup? Thanks.
Sure. Let me start with just the core bread, Steve, just so I'm clear on this. First of all, we've documented where our challenges are in the sweet baked goods category, a little bit in the soft variety white bread areas. DKB is not one of those challenges. DKB is a strong brand. It'll continue to be a strong brand. There is a bit of noise in those numbers. We had a SKU rat deletion of a couple of underperforming SKUs that affected it. If you're looking at the fourth quarter, there's always some seasonal noise in there. The fourth quarter is typically fairly weak for sandwich bread. But nonetheless, we did still see very, very strong growth in some of our breakfast items, sandwich buns and rolls. And I'd add to that, we've got new products coming this year to replace those deleted SKUs. Plus, we're getting very significant space gains this year for Dave's, which is really important. One of those of note is in the mass channel in over 2,000 stores where DKB has been underpenetrated. And I guess the final thing I would mention from a household penetration standpoint, DKB hit a record this year, even higher than the pandemic year of 2020. So, all that points to continue consumer interest in Dave's. We'll of course continue to innovate with Dave's, and we're not worried about that at all. So hopefully that helps give you some color. And then of course you add the snacks on top. The bars continue to do very well. We're really excited about the Snack Bite launch, which is underway as we speak. So as you think about it, more as a mega brand, we're even more confident.
Okay, that's very helpful. I appreciate it. And if I could, maybe a two-part follow-up, and then I'll pass it on. The first part is for Steve. I just wonder if you could better dissect the kind of the first half, second half dynamics that you called out in the prepared remarks. You cited some dynamics that will definitely help the early part of the year. At the same time, as you go forward, underlying comparisons ease. You've got Simple Mills rolling in. You've got the extra week. So I would have expected maybe a little bit different cadence, maybe some color there. And then Riles, second part, you mentioned some external research on GLP-1 drugs and related consumer behavior. I'm just curious if you could elaborate on what that research is, and kind of what you're seeing there and how you're going to address it. Thank you.
Sure. The first half, primarily what we're looking at in the first half is, we'll begin to lap some of our new business, and lap some of our pricing and some of our savings gains that we saw last year in the back half. There is some pricing that carries over in the back half on primarily private label and food service, but a lot of the branded pricing we do lap in the first half. And then the other major item for the first half has to do with commodity costs and input. The way we take coverage, we are seeing some benefit in the first half of 2025, but given some of the firmness you've seen in markets of late, right now we're forecasting some continued inflation with regard to the input costs in the back half.
Okay. Steve, to your question on GLP-1s, yeah, I mean, it's a fascinating topic, right? And everybody's still trying to figure out what the impact is, what the magnitude of the impact is, what the magnitude will be going forward. And we're scanning all the research, like I'm sure many of you are. Some of it's conflicting, so it's hard to get a firm handle on it. But we do want to be cognizant of it. Some of the work that we mentioned in the prepared remarks is from some work we did with Circana. So that's where that came from. But what I would say is that, if GLP-1s do become a major factor and, affect overall food consumption, we think that we're very well positioned for that. You see where we're taking the portfolio. It's definitely, starting to skew much more better for you. Cleaning up labels, the dominance of DKB, having Canyon, and of course adding Simple Mills to that mix too, because a lot of these people that are on GLP-1s will be searching for items just like Simple Mills. So, with all those factors in mind, we're shaping our portfolio to meet that new consumer that is taking those medications.
Very good. Thank you. I'll pass it on.
Thank you. One moment for our next question. Our next question comes from the line of Bill Chappell from Truist Securities.
Thanks. Good morning.
Hey, Bill.
Just a little more, color on your caution for the category and in terms of what you're seeing. And I guess it comes with, do you have pricing power or the consumer's weakened? Is it just behavioral change? Because obviously some more people are going back to work and maybe not having as much bread at home. Are there any macros that drive that caution, or is this just trends you've been seeing and we came into the fourth quarter and you expect them to continue as we move to early next year?
Yeah, Bill, it's mostly the latter. So sort of overall pressure on the demand environment. But I would add to that, specifically to our category, it's that consumer shift away from soft variety and white breads, which I think we're very well prepared for. We talked about it in the prepared remarks. I mean, soft variety and white bread were weak. I'm talking in terms of the whole year now, not just the fourth quarter. However, the investments that we've made in innovation around keto and gluten-free and organics and our sandwich bun and roll business, particularly under the national Wonder label, were more than enough to offset that. So if you take the cake piece out of branded retail, we were positive in units and dollars for the year in branded retail. Cake is really where the weakness has been. So, the outlook, we've seen some of those trends from last year, spill over already into the little bit of this year that we've already experienced, though it's obviously very early. I do have some confidence that QSR will start to recover. We're starting to see more positive comments around that. So perhaps second half, this year, some of that, volume will come back to our food service business, helping overall volumes. But, from a branded retail standpoint, we feel very good about where we are, branded bun and roll wise. with the brands that we have, the innovation we have. And then with respect to the cake business, the introduction of the Wonder brand is the intention of that is to help stabilize that business. It has been weak. The category's been weak overall, as you all know. But the reception that we've gotten from our Wonder snack lineup has been tremendous, honestly. And if the retailers follow through with that, this will be more of a second quarter thing because it doesn't launch until week 17. So it won't have any bearing on the first quarter. But we're very optimistic that will help stabilize that piece of the business. And obviously that has a profound effect on, just given the weakness on the cake side of things, that has a profound effect on our outlook for the year. So starting the year, definitely taking a cautious outlook for all the reasons that I just enumerated. The promotional environment has continued to be somewhat elevated. I wouldn't say it's ridiculous, but it is elevated, though. What we're seeing in terms of lifts are not what one would normally expect. Speaking sort of total category, we've been much more nuanced in our promotional behavior. But the category overall has been somewhat elevated, so we're keeping our eye on that too. Really, honestly, a continuation of the trends that we talked about on last quarter's call. There hasn't really been any marked change to that yet. Certainly looking to see if we see some improvement in consumer demand in the back half. So that overall is what's driving the cautious outlook, at least to start the year.
Got it. And just, I guess, as a follow-up, I guess what I'm trying to understand is why, if you have ideas why there's a migration away from the white bread, it would seem that it's still a kind of a low-cost solution for lower-income consumers. They're not sure what they would be trading up from $1 a loaf, private label white bread to Dave's Killer Bread at $4. So I'm just trying to understand, if you think this is a temporary or this is part of a trend, and if the kind of the factors that are really driving that.
Yes, we do, and that's what I'm trying to say. I think that it's more of a secular shift away from those categories. I think it's we've talked for several years now about the shift to more differentiated premium items. So some of that obviously is coming to us in the terms of Perfectly Crafted and Dave's Killer Bread. Other parts of it are going to the perimeter of the store. Other parts are going to tortillas and flatbreads. So consumers are looking for something different. Yes, there's still value, and there's still value consumers that buy private label or Wonder or Nature's Own butter bread. But it strikes me that there's definitely been a shift in tastes and preferences away from those mainline items. So we've been ahead of this, as I mentioned, and with our keto lineup and everything else that I talked about, we're meeting that new consumer demand and so far offsetting the softness in those traditional categories.
Got it. Great. Thanks for the color.
Thank you. One moment for our next question. Our next question comes from the line of Robert Dickerson from Jefferies.
Great. Thanks so much. Couple quick questions. I guess just, first question, as we think through the year, kind of cadence of the year, maybe this goes back to Mr. Power's question as well. Should we kind of be expecting, some kind of, let's say, more category softness, right, in the first half of the year, maybe until you lap the category softness? So if we're thinking about top line and just, organic volumes in general, I guess combined with maybe some of the innovation that comes later in the year, then maybe, we're a little softer top line first half, and then hopefully there's a little bit of momentum as we get through the back half. That's some simple first question.
Yeah. So from a top-line standpoint, I think that's roughly correct. I don't really see any change in the consumer demand environment anytime soon overall. But we do have, as we mentioned, the Wonder launch will be right at the beginning of the second quarter. We actually have a lot of new business wins, significant business wins. Most of those come in, after the end of the first quarter. So, I think as you think about cadence through the year in terms of our efforts to win new business, geographic expansion, new items, innovation, that's mostly at least a post first quarter item. And then, as I mentioned, QSR demand, that coming back would certainly be helpful for the food service side of things, but I'm not sure we see that until the second half either.
Yeah. Okay. Fair enough. And then Riles, maybe just on, coming back to, the conversation around, traditional white loaf, et cetera. I mean, I do feel like, right, I mean, if we go back like a decade, right, I don't know, whether we think of some of your core competitors in bread and we think about kind of just like how the shelf looks, right? If I personally walk in a grocery store, now we have 18, 27, 32 grains, right? We have country white, hearty white, Hawaiian. I mean, there's so many different options now in bread, right? I mean, we're kind of simplifying to an extent, right? Like there's a little bit more premium, or, let's say better for you. I mean, I could argue that it depends on how you're defining better, but whatever. Is there, maybe just a part of the market where within bread, and let's, ignore Dave for a second, where you clearly, could or should, or maybe you do, right, have an opportunity, to kind of more effectively compete, let's say, with, I guess we could call it more harder loaf, right? I mean, you're calling it soft loaf, because it does feel like there's maybe a little bit more traction on that side, and maybe that's just viewed as more premium, even though maybe the health attributes aren't better. I don't know if that makes sense.
So, Rob, are you talking like more artisan crusty bread?
No, I'm talking about like if I go to the grocery store and I look at Arnold and Pepperidge Farm and they have like, harder, more, kind of more solid country white, hearty white. I'm seeing people maybe purchase that a little bit more frequently relative to the softer loaf dynamic. So I'm just bucketing the different subcategories differently.
Yeah, and I think that's a great example of where the market is shifting to. So if you think about white breads, for example, and what we've done with Perfectly Crafted. So, while the traditional loaf under Nature's Own has been selling, Perfectly Crafted was up 8.5% in units in the fourth quarter, which is typically a weak quarter. So that's one example. And there, we have a white bread under Dave's as well. So that's giving the consumer a place to go that's more premium and more differentiated than those mainline items, to your point.
And then, so like, if we just think about the overall supply chain, like, does it make sense to maybe just like gradually infill some of the, shelf on certain brands with maybe the examples you just gave? I don't know if there's like a cap on the TAM, but it would seem like, market's going that way. Maybe it takes you a little while to get there, but feels like you have the capability to kind of get there.
Yeah, no, I think that's right. I mean, it's as you say, it's an evolution over time. I mean, it's down, but make no mistake, there's still a lot of Nature's Own honey wheat sold. So it's still, from a volume standpoint, it's still a huge piece. Same for butter bread and the other mainline Nature's Own items. But plants are pretty flexible, Rob, as you'll recall. So as we move forward and the consumer preferences shift, we can run these items on the same lines we already have for Nature's Own. So, there's a lot of Perfectly Crafted made in the Miami bakery, for example, which, we've had for 50 years. And, it makes Nature's Own butter bread, but it also pumps out the Perfectly Crafted as well. Dave's is a little different, obviously, with the organic, and obviously gluten-free is even more different just given the segregation required. But, our network is set up to be flexible in that regard as those preferences shift.
Yeah. Okay, perfect. Makes sense. And then just maybe one question for me on the Wonder Snack launch. I mean, within the prepared remarks, right, I guess kind of the term or terminology around, healthy consumption, better for you, et cetera, does continue to pop up. Kind of we're all aware around, what's going on in the perimeter relative to the center of the store. I mean, I guess one could argue it either way. Maybe, a Wonder cream-filled confetti cake is more premium, or maybe for somebody it's classified as better for you. But it seems like, maybe it's just a good opportunity to kind of take some of the capacity you already have, right, within sweet baked snacks and just try to shake it up a little bit, right? I mean, clearly Wonder, it has very high consumer awareness. I mean, it's probably one of the highest within all of baked goods. So, like, is the idea as you speak with the retailers, hey, here's a category that's clearly, under a bit of pressure, and it's been that way for some time, and there haven't really been a lot of new entrants, right? So maybe this is something that could actually, work as consumers want something new, and trial, not necessarily because it's premium or better for you. That's all. Thank you.
Look, I think you said, I think you said it. I think you said it very well. I mean, Wonder is an iconic brand. It's got 98% awareness, so it's among the highest in food. And we've talked a lot about the fact that one of our competitive issues in the cake business is just the lack of a brand, to go up against the larger players with. We're a bit disadvantaged from that standpoint. I mean, Tasty's a great brand, if you're from Philadelphia or the surrounding area, but if you're from Cairo, Georgia, maybe not so much. But Wonder definitely resonates. I would also say that the quality is also a factor, and we believe that our quality is superior, and we've been told by our retail partners that our quality is superior. So we think that gives us a nice competitive advantage as well.
And just quickly, could that product line be launched nationally, kind of relative to Tasty, or is it probably more in the kind of a Tasty cake regional play?
No, we can go national with Wonder. A, it's a national brand, and B, this is all warehouse distribution. So we're not limited by the DSD now.
Yep. Super. All right, awesome. Thank you. Appreciate it.
Okay.
Thank you. One moment for our next question. Our next question comes from the line of Jim Salera from Stephens.
Yes, good morning. Thanks for taking that question. Rouse, appreciate some of the detail on 2025. I wanted to maybe parse out some of the legacy business. If my back of the envelope math is correct, if I take the midpoint, strip out the 53rd week in the Simple Mills acquisition, that gets just shy of like 1% growth for the core 52 on 52 week legacy business. How should we think about the kind of expectations for the components there? It seems like maybe food service still down modestly. The core bread offering maybe up a little bit, and then sweet baked goods kind of a variable. So if you could just kind of give us a sense for the components of the legacy business for 25.
Yeah, I mean, I think you're thinking about it right, number one. But secondly, I'd say a lot of that 1% growth will be mix driven. And as Ross pointed out, the performance of our premium brands continue to be really strong. So we're forecasting good performance for 2025 from that perspective as well. We believe, as Ross said, Wonder Cake, should help from a cake perspective. But again, that doesn't really kick in until, the second quarter. And, we are expecting some recovery from, quick serve food service during the year as well. So when you look at kind of that 1% growth, a lot of that's going to be mix driven. From a pricing perspective, we've taken pretty substantial pricing over the past couple of years. There might be a pocket here or there or something very selective, but for the most part, it will be, mix driven.
Okay, that's helpful. And then maybe a second question on some of the innovation and formatting. Roz, in your prepared remarks, you mentioned having the opportunity to offer consumers smaller loaves that maybe make the product a little more accessible from a absolute price point perspective. And then also they don't have to worry about spoilage and maybe throwing away the couple extra slices. Can you just give us some detail? Is that across the whole portfolio, or is that just with certain brands? Is there an opportunity, especially thinking about GLP-1 impact, to kind of expand that across the portfolio to make it more accessible and reduce the waste?
Yeah, I think it's a we'll see right now, Jim. We currently only have it under the Nature's Own brand for the small loaves. We are looking at it for Wonder as well. And then, of course, this is not exactly analogous, but DKB has had for a long time the thin slice, which is a much smaller loaf than that big, super premium wide pan bread. And we do find that it's a lower price point. Obviously, margins are still good for us, and that's a consumer need that we're trying to meet. There are others out there. We're not always the first to market. We weren't the first to market with keto, and yet we're number one in that subsegment now. And there have been others that have been earlier to market with the small loaf, and we've been watching it. It's done well. It's obviously a need for certain households, and so we elected to meet that demand.
Great. And then maybe if I could sneak in just one last. Rob, you mentioned very briefly in the beginning of the Q&A just some uncertainty on tariff. Can you just give us maybe just high-level thoughts on what tariff exposure might be and just any impact that might have?
Yeah, Jim, this is Steve. I mean, I'm sure you'll assume this. Basically, it's ingredient driven. When we have taken into consideration some estimates of the tariffs, and that does flow through our guidance. We looked at ways to mitigate that the best we can. But the reality is, a lot of it's ingredient driven, and as you would expect, most of it's Canadian or Mexican driven. But there is some from China, but the majority of it would be from those two countries.
Okay, great. Perfect. Thanks, guys. I'll pass along.
Thank you.
Thank you. One moment for our next question. Our next question comes in the line of Brian Holland from D.A. Davidson.
Yeah, thanks. Good morning. Maybe just following up on some of the earlier lines of questioning, I think Jim's point implied 25 guidance top line, excluding acquisitions, excluding 53rd week. We're looking at like 80 bips of growth at the midpoint, which I think on its face looks modest. But for the last 3 quarters, your sales have declined. Volumes have gotten worse. Category trends are softening as we move, further softening. I'm talking about all packaged bakery as we move through Q1. So I guess it maybe to the extent that you could sort of parse out, because it strikes me that innovation is the incrementality of that, and maybe some of the new business wins on the food service or in the non-retail business would be the primary drivers above and beyond maybe a down category and just some natural share growth on your part. So maybe more at its most simplistic, do we have a bigger innovation wave in 2025 and 2024? And where does that fall if you were to tier the drivers, bridging from where the category is to where you're guiding for 25?
Yeah, Brian, so lot to talk about there. So several things. One, I think I heard you say new business in the away from home. Most of the new business is on the retail side. So we are picking up some private label, but we're getting a lot of brand concession for that as well. I mentioned at the outset of the call, part of that is some significant new space for DKB, which is going to be great for us. And some there's a litany of others. Then you also have the Wonder launch, as I mentioned, that's going to be second quarter. It won't have any effect on the first quarter, so that's going to be a big part of it. And then to answer your question on innovation, yes, we do have a higher innovation goal for this year than we did last year. So it's a combination of things, and all of that's intended. We're still saying, for the time being, we're not expecting any major positive changes in consumer demand. That's why we started the year cautious. But all this stuff is meant to offset that. And then, of course, if consumer demand starts to improve, which we believe it eventually will, we're very well positioned to take advantage of that.
No, appreciate that. That's all helpful. Thank you. And then just quickly on Simple Mills, I think you put 2024 net sales last month at $240 million. Your guidance in 25 implies something a bit below that. I suppose that's probably just less than full year contribution explains the implied decline. But if I have that right, just a sense for kind of what you're assuming for that business on an apples-to-apples basis in 2025?
Yeah, I mean, for 2025, obviously, it's roughly 45 weeks if we, stay on the closing schedule that we've assumed here. And then from an overall growth perspective, we are assuming some modest growth for 2025.
So is that, if you say modest growth for 2025, I think the business has grown at like a mid-teens CAGR or something like that. Is there anything with respect to just, integration, et cetera, that you might explain why the implied guide for that business would look more conservative than what the historical trend has been? Or is that just conservatism, not dissimilar to the way you're trying to approach your core business?
Yeah, let me comment, and Steve can add on to this. First of all, it's a little tricky for us because we haven't closed yet. So, we're assuming a certain number of weeks in this contribution. So we've kind of given a range to give ourselves a little bit of breathing room there, just because we haven't closed yet. We do expect it to be soon, but as of today, we haven't closed. The second thing I would say is that we're very, very bullish on this business. We wouldn't have paid the premium that we did if we weren't. But we do need to get them. We need to get them integrated, and we can't do a lot of that, obviously, pre-closing for regulatory reasons. But once we get in there and we decide how we're going to work together, and the things that we can bring to them to accelerate their distribution gains, their innovation pipeline, et cetera, it'll take a few months for us to get there. So I think it'll come into much clearer focus, though I know it's probably frustrating for your modeling efforts. It'll come into clearer focus after we get closed.
Yeah, and Brian, yep. I don't know if you had a chance to look at the deck yet, but on slide 7, we do call out that we're assuming a full year pro forma contribution of roughly $258 to $266 million from a top line perspective. So that should be able to help you from a modeling perspective.
Oh, okay, thank you. That is helpful. And then, if I could sneak in one more, just any thoughts, Riles, about how the promotional landscape might evolve as commodities become a headwind for the category into 2025? I think historically, an inflationary environment upstream has tended to be beneficial for Flowers, just given kind of your hedging strategy vis-a-vis the balance of the category. So maybe just any thoughts there?
On the promotional environment, you mean?
Yeah. Right. I mean, I think we're seeing we have seen an increasingly competitive environment. I know you've talked about that being below pre-COVID levels, but yes. Commodities have been a bit of a tailwind to help support that. If it goes the other way, if you assume that a lot of the smaller independents don't have the same hedging or forward buying practices that somebody like a Flowers might have, that they would have to correct more quickly to account for that. And again, historically, I think that's been a net benefit for Flowers. Just curious how you think about that.
Yeah, I would think about it exactly the same way, though it'd be just pure speculation to figure out, exactly when, that might happen and what they might do and when. Yeah, you're right. Historically, it has, overall been a benefit. And I mentioned a while ago, we've been watching the promotional environment very carefully. No surprise. I mean, for us, the base units have been, a little bit weak, but our promotional cadence has delivered, some pretty nice incremental units. On the other hand, we have seen more broadly across the category, deeper, perhaps more aggressive promotions, and our analysis shows that those are not delivering from an incremental standpoint. So, certainly my hope is that that stabilizes and pulls back. But in the meantime, we're going to continue with the same strategy we have. I mean, we have the number one brands. We don't have to promote as deeply because of the strength of those brands, and we'll continue utilizing that strategy.
Great, thanks. We'll leave it there.
Thank you. One moment for our next question. Our next question comes from the line of Mitchell Pinheiro from Sturdivant & Company.
Hey, good morning. Most of my questions have been asked, but I do have just a couple things regarding guidance. As the Flowers standalone, earnings per share is flat to down versus 24, but you have perhaps a modest increase on the top line. So is that gross margin, or is that SD&A decline or pressure on earnings?
I think you'll see more pressure within SD&A.
And is that workforce related? Is that related to California transition, or just general, workforce related pressures?
I think you'll continue to see some of the pressures we talked about on Q4. You'll continue to see workforce. You'll continue to see an increase in overall lease or rent expense. So it's really is related to the truck leases and rentals for California. And then you'll continue to see cold storage expense increase as well. So there's several factors within SD&A, are forecasted to be up year over year. I think from a gross margin perspective, we're not really guide, but I think overall we should be okay, 24 to 25.
Yeah, Mitch, as well, just remember that as we move through the first quarter of this year, Steve already mentioned the lap of the pricing, but we will also start to lap the savings initiative that we launched last year, that $46 million that we saved in 24.
Okay. And then, you had a comment, I guess, in the prepared remarks talking about the California transition going to drive some improved results. What are you trying to say there? Is that, because that's going to be a company-owned model versus your traditional, independent model. Is that saying that you could be more efficient as with a company-driven model?
Yeah, I think I would think of it in terms of control. Obviously with our IDP model, we have very limited control there because they're independent business owners, as you know. Whereas with the transition in California, kind of taking back control over distribution, days of service, display execution, we have a lot more ability to drive our business ourselves with an employee model there. Now, Mitch, as you know, we were forced to do that in California. This wasn't necessarily by choice. So we'll see how it goes. On balance, as we've mentioned, it is a little bit more expensive to use a company-owned model than it is IDPs, primarily due to the truck expense that's on our books. But our aim is to more than offset that via that control with enhanced sales growth. Primarily, honestly, if nothing else, increased days of service. We all know how important Sunday service is, and that can be somewhat uneven with an IDP model.
Okay. All right, thank you. And then just one other thing, and I forget, maybe someone else asked this already, but the small loaves that you're putting out, you've always you've thought about it before, but it sort of didn't quite make sense in years past for a variety of reasons. Have you solved any of the small loaf margin issues, or is that something that you got the right margin mix there, or could it be a margin drag for you?
It's not a major margin drag, Mitch. First of all, it's not big enough yet really to have that big of an effect. But to answer your question, it is a little bit lower than the mainline items, just due to the fact that we're not really set up to just produce a small loaf. There's some complexities in the plants. However, if we start to find success with this, we would go and make the necessary changes in the plants to fix that. And that would go a long way to helping the margin profile. I'm not really worried about it right now. This is really more of a test and learn circumstance for us. But if it's doing well, if it continues to do well, we've got more SKUs coming out to help support it. If it really takes off, then we'll make the necessary investments on the supply chain side.
Okay. All right, that's all I have. Thank you for your time.
Thank you. One moment for our next question. Our next question comes from the line of Max Gumport from BNP Paribas.
Hey, thanks for the question. Just turning back to the commentary on promotions. So you're clearly of the mind that the promo intensity we're seeing is not the solution to volume pressure in the bread category. And that sounds like a prudent approach to be taking given the lack of lifts that we're seeing. It's not clear, though, that your competitors are of the same mindset and stepping away from promotion. So how would you think about navigating through an environment if you have large competitors that continue to promote through the year, even if a bit irrationally? Thanks.
Yeah, right. Can't control what they do. Understand that, but I think, simply put, if you look at our market share performance relative to some of the competitors that you're talking about, I think you'll find your answer there. Our performance has been much better, and we don't promote nearly as deeply. I think our overall price per unit was down maybe a penny in the fourth quarter. 1 penny, up 1 penny in the fourth quarter. Sorry, in the fourth quarter. So that and that typically tends to be a higher promotional quarter just given the seasonality, and yet our market share performance was better. So I would leave it at that.
Okay, and then turning back to the expansion of Wonder into sweet baked snacks. So, I mean, clearly you noted that one of the biggest headwinds you're facing right now is that weakness in the sweet baked goods category, and you're planning to address that head on with the introduction of Wonder snack cakes. I guess I'm just wondering why that's the right strategy. I mean, to me, it would seem you can choose the categories that you play in, and so I'm wondering why you're choosing to get bigger in a category that's one of the weakest in U.S. packaged food right now, and potentially due to structural issues at play. So just curious, why snack cakes and not another category that maybe has better growth tailwinds behind it.
You mean with the use of the Wonder brand?
Exactly. Why expand Wonder into snack cakes now? Why is snack cakes the right category? Why not think about a different category that isn't under a whole lot of top line pressure?
Right. Well, I would put it this way: we're in the sweet baked goods business, and it's a headwind, and it needs addressing. I think that's very clear, and we've documented it for a number of years that it's been a headwind from us, first operationally and now from a top line standpoint. And we think that Wonder translates much more easily and seamlessly into the sweet baked goods category than it might others.
Okay, and then I'll throw in a third question as well. Just could you provide a bit more color on the Circana research that you're citing, particularly with regard to the comment about how you're seeing, or Circana is seeing, households on GLP-1 drugs start to revert even more fully back to center store items? Curious, are there center store items in particular that they're reverting to? Did they give you any reasons for why that counterintuitive shift is occurring? Thanks very much.
Yeah, sure. The research that we're citing is, as I said earlier, one of many. I think some of these even tend to conflict with each other. But yes, we have seen some data that shows that people start that medication, and when they stop, they come back and they buy more than they did before. But I think it's one point in time, it's one data point. I would caution everyone on that. I've been very clear that I don't think anyone has gotten this completely figured out yet or knows what the long-term implications of it are. I think the important thing to note is that regardless of the outcome, we're positioning our portfolio to be successful in any environment.
Okay, thanks very much.
Thank you. At this time, I would now like to turn the conference back over to Ryals McMullian, Chairman and CEO, for closing remarks.
Thanks, Gigi. I want to thank everybody for taking time today and joining us for questions. Thanks very much for your interest in our company. And as always, we look forward to speaking with you again next quarter. Take care.
This concludes today's conference call. Thank you for participating. You may now disconnect.